Hey guys, Happy New Year and welcome back to the channel. Now, I don't know about you, but this year I want to make some money on the stock market. But obviously that's easier said than done, considering 70% of retail investors do actually lose money on the stock market. So in this video, I'm going to show you 5 foolproof hacks that you can implement as a beginner investor to become profitable and join that 30% that actually do make money. Because in today's climate, it's never been more important than now to start investing, as a way to shield your savings from inflation. Now, as a disclaimer, I am not a financial advisor and this should not be considered financial advice. I am, however, a retail investor with over a decade's worth of experience, and I have been able to build a profitable portfolio over that time period. So with all of that out of the way, let's get into it. So if you're at the start of your investment journey, the first thing you need to make sure you do is pick the right type of investment account. There are quite a number of different types of investment accounts, as well as a whole range of different platforms that you can pick, so it does make the whole thing a little bit overwhelming. But the type of investment account you need to build wealth over time is an investment ISA. And what's so great about investment ISAs is that all of the profits are completely tax-free, and any uninvested cash you have within your ISA is always instantly accessible, and you can withdraw it at any time. Every other type of investment account doesn't have this tax advantage, so you will be subject to capital gains tax, dividend tax, and also income tax if you have cash held within your investment account that's earning an interest. You are entitled to a tax-free allowance for each of these types of taxes. However, the allowances are so small these days, and they're getting smaller, and it's very easy to creep over the threshold where you have to start paying tax. The only drawback of an investment ISA is that you're limited on how much money you can deposit each calendar year. And that limit is £20,000 every tax year. This ISA limit might cause difficulties for some people, however for the majority of people starting out investing, it hopefully won't be an issue. Now when you set up your ISA, there are loads of different options out there and loads of different platforms to choose from, and it's completely up to you what you go for. But personally, I would stay away from the do-it-for-me investment platforms as they're quite easy to outgrow, and if you want to transfer your funds at a later date to a more advanced platform, you'll be charged a fee for doing so. Now my personal favourite and the one I use for my investment ISA is Trading 212. They give you access to a huge number of stocks and investment opportunities, but it also has some really useful tools which you can use to help automate your investments, which I'll go into a bit later. Next up on the list, you need to keep your portfolio simple. Over the last decade or so, there's one sector that's been driving most of the growth on the market, and that's the US tech sector. And until that changes, which I personally can't see happening in the near future, that's where you should be investing. With that being said though, I'd avoid chasing high growth investment opportunities with individual stocks. Yes, you can stand to make a lot of money if you get it right. However, often timing is key, and it's very easy to lose a lot of money trying this. Now the foolproof thing to do is to invest in index funds. The first I would suggest is the NASDAQ 100, which is an index made up of the 100 largest US tech companies. Over the last 30 years or so, it's offered on average around 10% in annual returns, despite 2 huge financial corrections during that time period. And over a shorter time horizon of 10 years, it's averaged about 20% in annual returns. As well as investing in the NASDAQ 100, I'd also go for the S&P 500. Now this index is made up of the 500 largest US companies, and within these 500 companies, a lot of them are similar to those within the NASDAQ 100. But overall, it's less volatile and more resilient during downturns in the market. And since the S&P 500's inception, it's averaged around 8 to 10% a year in annual returns. The easiest way to invest in these indexes, rather than buying all the individual companies within them, is to invest in an ETF which tracks the index. There are loads of different ETFs out there that do vaguely the same thing, but my favourites are from iShares, and the tickers are CNX1 for the NASDAQ and CSP1 for the S&P 500. Now people love to talk about diversification and how important it is to spread out your risk across different asset classes. Now in theory it does sound like it makes sense, but in practice it's a load of nonsense. Usually when people talk about diversifying a portfolio, they like to include things like corporate and government bonds, which are seen as low risk investments, and also they like to have exposure to other markets. But from my experience, all this will do is limit your profits. And honestly, if you go for a low risk, low return investment, you're increasing your risk of having your investment portfolio get eaten away by inflation. Currently, the US stock market is much stronger than any other when compared to Europe, the UK and Japan. And over a long period of time, this has also been the case. So from my point of view, it just makes sense to stick with the one that's winning and not diversify for the sake of it. Now, if we look at the influence of bonds again, I've plotted this chart showing CNX1, CSP1, which are the NASDAQ 100 and S&P 500 that you can invest in, against 5 diversified Vanguard funds that all include bonds to different extents. Now, if we look at this over a 5-year period, the correlation could not be more obvious. the inclusion of bonds and diversification just saps progress out of the fund's performance, and as a result reduces your profits. And this is also true on a 3-year and a 1-year time horizon. And you can also see that the Nasdaq and the S&P 500 massively outperform all of these funds on each of those timescales. So until something serious changes in the market, in my opinion, this is the best strategy to go for. Now, once you've chosen what you want to invest in, the next hack is to use dollar cost averaging. This is effectively a strategy where you consistently buy shares every single month or week, depending on what you choose to do, irrespective of the current share price, on the understanding that over time it will give you exposure to the long-term growth of the asset. So some months you may be buying at a premium, others you might be buying at a discount, but over time it will average out, and in theory you should get some solid returns providing you've invested in the right type of asset. And the idea is that it shields you from market volatility and limits the risk of you timing the market poorly and buying at the top, which can be catastrophic if you've gone all in at that high price and don't have any other capital available to purchase more shares once the price dips, to average down that price. Now, this may sound like a really boring strategy, and you might think that you'll be able to time the market better than this, but in practice, most experienced investors can't beat the returns of dollar cost averaging. Now, the easiest way to implement dollar cost averaging is by utilizing the technology in the investment platforms. So for example, within Trading 212, you can create what's called a portfolio pie, where you choose the stocks that you want to have in your portfolio and to what percentage. And then every week or month, or whatever you choose, Trading 212 will automatically invest into these stocks for you, and you don't have to lift a finger or remember to invest, which many people do struggle with when working full time. Now, I've actually gone ahead and made a pie which you guys can copy across to your Trading 212 accounts, which includes the stocks that we looked at earlier. So if you do want to copy that, the link will be down below in the description. And from there you can copy it exactly or edit it if you want to include anything else. But the most important thing to remember when dollar cost averaging is that it will not work over a short period of time. Dollar cost averaging only works over a long time horizon, and you can't be discouraged if you're not profitable within the first few months. But you also need to know that the investments you've chosen will be solid over a long period of time. Now, the fourth hack, which a surprising number of people don't bother to do, is to track your investment progress. Unfortunately, most investment platforms aren't particularly complete when it comes to tracking your long-term progress. Now, due to this, I think the best thing to do is to simply keep track of your portfolio balance at the end of every single month in a spreadsheet. The way I do it is with my own investment tracking template, which I'll link down below, but it's a free download on Google Sheets. I'm not going to explain exactly how it works, as I've got a full explainer video which goes through everything and how to use it, if you want to check that out. But the main premise of what you need to do to start gathering really useful data is input your portfolio value at the end of every single month, and then also note down any deposits or withdrawals from your portfolio. And from there, it will generate a performance chart showing exactly how you're doing, but it'll also allow you to compare your performance to any index that you want to. And from this, you can get a really good gauge of how well your portfolio is doing against the wider market. Now, the final hack for you guys is to simply carry on learning and try to consume as much information as you can about investing and wider economics, so that you can try to keep yourself informed and actually understand what moves markets. If you are new to investing, there really is an overwhelming amount of information to learn, and it's not going to happen overnight, but if you keep working at it, it won't take long to start feeling more confident. Like I said at the beginning, I've been investing for over a decade now, and I'm still learning new things about investing every single week. But the great thing is, the more time you put into improving your understanding, the more confident you'll feel. And you might feel confident to stray away from this simple investment strategy and then potentially start chasing some more profitable opportunities. If you did make it to the end of this video and enjoyed the style of the content or found it useful in some way, make sure to hit that subscribe and bell icon down below to stay up to date with all of my latest posts. Also, do check out my most recent video on Bitcoin, which up until recently has been something I wanted to have nothing to do with, but that has all since changed, and there are many reasons to be excited about Bitcoin, in my opinion, going into 2024. So I'll go over all of the details in that. But with that being said, thank you so much for watching and enjoy the rest of your day.